Well, we have been hit with a slew of data to end 2023, from a jobs report that showed a still robust labor market to cooling inflation prints, a more dovish Fed, and retail sales this morning showing that once again consumers remain resilient amid a holiday shopping season. Sales for November rising 0.3% on a month-over-month basis, where a dip was expected. So is it too early to claim victory over a soft landing scenario? We want to bring in Greg Daco. He's EY Chief Economist. Greg, it's great to have you here in studio. So I think investors are asking themselves this morning whether or not we're in the clear, if a soft landing is a sure bet at this point. What do you think?
Well, I think for 2023, that was the key question. Are we going to be able to achieve that soft landing? I think we largely have achieved it for 2023. We've seen an environment where inflation has come down within reach of the Fed's 2% target, and we have not seen the recessionary signals that were once feared at the start of the year. The question for next year is whether that soft landing can be sustained. And I think some of the easing signs from the Fed in terms of its pivot are encouraging in that sense. But we have to be careful. Cost fatigue and the labor market developments will still be the key drivers of economic activity as we navigate next year.
I mean, we were talking with CEOs and one analyst yesterday of the retail sector just about where the state of the consumer is. Does it feel like, as the consumer is becoming even more cost conscious, that we are already seeing some of that, or value conscious, I should say, in their words? Are we already seeing cost fatigue start to show up?
We're absolutely seeing cost fatigue. I mean, that's the big disconnect between how the economy is doing and how people are feeling. Consumer sentiment, business sentiment is quite depressed in this environment, and yet the economy is still moving at a decent pace. It is slowing, but it is still moving forward. I think that cost fatigue, whereby the cost of everything is much higher than it was pre-pandemic, is affecting how people feel and how they feel they're able to spend going forward. We're still seeing, as we saw in the retail sales data, that people are still spending more dollars. They're being a bit more cautious as to how many goods, how many services they purchase. I think that's going to be the key story as we go into 2024. And the key backdrop, the key anchor to a soft landing is a labor market that does not retrench. So far, we haven't seen the type of retrenchment that precedes a recession. Is that going to last?
So, Greg, with all of that, then I guess what is your projection, or what is your outlook or expectation right now for the Fed to cut rates? Because the Fed here signaling that maybe 3 cuts are on the table for next year. The market's still even a bit more optimistic than that. What do you think is realistic?
Well, I think the Fed's candid pivot towards the fact that it will be adjusting monetary policy was very important. Now that's behind us. This acknowledgement that inflation has been falling faster than initially anticipated is a very good development. Now the Fed will have to calibrate how rapidly and how much it cuts rates. But that first step is behind us, which is a good thing. It's a realignment with the reality of today's economy, an economy that is gradually slowing, where there's a rebalancing taking place between labor supply and labor demand, and where inflation is falling back to a level that would be less of a concern for the average day business leader and consumer.
With the number of cuts we've seen at the end of this year, is that a concern at all for you when you think about the broader labor market picture right now?
I think we have to be a little bit careful with the market pricing of rate cuts. The Fed is not going to be in a hurry to cut rates very rapidly unless there is a recession. And as I mentioned earlier, it's important to remember that labor market dynamics and cost fatigue are still going to be the key drivers of economic activity. There was a lot of rate insensitivity on the way up when the Fed was tightening. That's why we're not in a recession. We have to be conscious that on the way down, when the Fed is easing, there will also be less sensitivity to that easing. And so the euphoria about this soft landing and this environment where we're not going to see any slowdown perhaps is overdone. The Fed is not going to be slashing rates very rapidly.
Yeah, and Greg, to that point, Chair Powell did couch it a little bit just in terms of the fact he didn't fully rule out the potential for another rate hike down the line, very data dependent. Do you think another rate hike is totally off the table at this point?
We've been saying for a long time now that the Fed was at the terminal rate. It was pretty clear that there wasn't going to be the necessary increases in inflation that would push the Fed to tighten monetary policy further. I think we've seen that monetary policy is sufficiently restrictive to bring down inflation back down to the 2% target. I'm in the camp that the last inflation mile will not be the most difficult. We're seeing a number of elements that show that the disinflationary momentum is quite strong. We're seeing it in the CPI data. We're going to see it in the PCE data. We've also seen it in the PPI data in terms of margins. Wage growth is easing. And let's not forget, yes, there's a lot of hope that the Fed will cut rates rapidly, but monetary policy today is still very restrictive.
You mentioned in your notes, Fed Chair Powell appeared much more dovish than he has been in the past. What's it going to take for him to be able to bring some of the more hawkish remaining members over to his side?
Well, I think the key element in his statement was that the Fed is going to be considering rate cuts. It was acknowledging the obvious, something that most participants were pricing in, that the market was pricing in. Now we can move on to the calibration discussion. How many rate cuts and how rapidly should policymakers cut rates? I think one of the key dimensions that we've not seen in a while from the Fed is dissent in terms of the common view. There has been this consensus approach to policymaking whereby there haven't been any dissents to the votes, even though some policymakers may not necessarily have been in line. That's very different to what we're seeing at the ECB, at the Bank of England, where there are opposing views. We may see a little bit more of that as we move into 2024, because if you look at the dots in the dot plot, not everybody is of the same mind when it comes to how much easing is necessary over the next year.
Love that dot plot. My goodness. Greg Daco, who is the EY Chief Economist, joining us here today. Thanks so much for the time. Always appreciate it, Greg.
Thank you.